Welcome back. In this video, I'm going to talk about information, competition, and stock prices. Remember that this is the third video, and we also have two previous videos, one on cash flow valuation models, and I have a separate video on valuation based on comparable firms. I'm going to talk about the information that is reflected in stock prices and answer the question, does the stock price report a fair view of the value? And the fair view of the value is also called true value. Okay, so remember from the previous video that a standard valuation model links the future cash flow, cost of capital, with its share price. We also call this the valuation triad. This means that given an accurate stock price, the valuation model will help you solve for the expected cash flow of the firm or the cost of capital. In the previous slide, we said that based on the current stock price, a valuation model will tell us something about the future expected cash flows or cost of capital. However, how reliable is the stock price that you get from the financial market? Now, we know that when we have a publicly traded firm, its stock price should provide very accurate information about its value, and because of two reasons. One, the stock is listed on an exchange, and that means that all information about the company can easily be assessed and is publicly available. Two, a multitude of investors are able to trade in the stock. So in this case, when dealing with publicly traded firms, these two criteria are met and we argue that a stock reflects its true value. In the next few slides, we're going to discuss the efficient market hypothesis and how the financial markets deal with new published information about the company and how it should impact its stock price. The relationship between information and stock prices is well captured in what we call the efficient market hypothesis. In a nutshell, it says that the stock price reports a true value because of two reasons. All information is publicly shared and is available in the market. And two, this information is captured in the stock price because investors buy and sell the underlying stock. So the efficient market hypothesis assumes that all publicly available information is reflected in the stock price. And as a result, the stock price reports a fair view of the value, or what we also call a true value. But what about new information? How does the stock price respond to that? The efficient market hypothesis tells us that the stock price will react nearly immediately to such news if the new information is shared in the market and can easily be used by the investors. Know that the efficient market hypothesis also provides a framework to detect insider trading. Now, this kind of trading is illegal because it has a very disturbing effect on the stock price. And why is that? Because insider trading means that you're trading against the principles of the efficient market hypothesis. That is, as an insider, you can't buy or sell company shares with private information for the simple reason that the information that you have used is not shared in the market and therefore not publicly available to all investors. Trading with this private information then has a disturbing effect on the stock price. Let's have a look at example 6. The case goes as follows. Pfizer announced that due to potential side effects, it is pulling one of its leading drugs from the market. As a result, its future expected free cash flow will decline by 85 million per year for the next 10 years. Okay, Pfizer has 50 million shares outstanding. no debt, and an equity cost of capital of 8%. If this news came as a complete surprise to investors, what should happen to Pfizer's stock price upon the announcement? Let's have a look at the answers of example 6. In this case, we can actually use the discounted cash flow method. Remember that we have no debt, so that means that the cost of capital is equal to the cost of equity. Now, using the annuity formula, which is pretty standard in the finance literature, we can actually calculate the present value of the decline of 85 million per year for the next 10 years. The present value is 570 million, which means that the 570 million today is equivalent to a decline in cash flow for 85 million for the next 10 years. So the enterprise value should be reduced with 570 million euros. If we have 50 million shares outstanding, the share price should fall by 11.40 per share. Now, because this news is public and its effect on the firm's expected free cash flow is clear, we would expect the stock price to drop by this amount nearly immediately. In the previous case, we had the efficient market hypothesis, assuming that all information is publicly available and that information is reflected into the stock price immediately. Now, in the case of private or very difficult to interpret information, we know that private information sometimes is held by a relatively small number of investors. And these investors may be able to profit by trading on that information. And this is what we call insider trading, and that is illegal as discussed in one of the previous slides. Remember that in this particular case, the efficient market hypothesis will not hold in a strict sense. So if investors with some private information are going to trade, they will tend to move prices. So over time, prices will begin to reflect that information as well. Now, how can you make use of this information before the whole market knows? Well, if you have somebody on the inside of Pfizer and before they're going to announce the failure in the market, you're going to act on it. And what are you going to do? You're going to short sell. And short sell, in a nutshell, is a trading strategy that traders use to take advantage of markets that are falling in price. Note that short selling is way beyond what I would like to cover in this video. However, since I have spoken about short selling, I might as well explain in a little bit more detail how it works in this particular case. Okay, so when you are short selling, you are selling a borrowed asset in the hope that its price will go down and you can buy it back later for a profit. So in the case of Pfizer, what I'm going to do with this private information, I'm going to sell you today the stock for, let's say, 50 euro. And I'm going to tell you that I will hand you the stock, not today, but in 1 week time. Now, the smart thing is that I don't own the stock Pfizer yet, but I know that tomorrow, when the bad news of the side effects is announced, that the value of Pfizer is going to fall with 11.40 euro. And nobody else knows this, I'm the only one. So what I'm going to do then, I'm going to buy the stock with a discount of 11.40 euro tomorrow or the day after that, and I'm going to keep my promise and hand you Pfizer stock for 50 euro at the end of the week. Let's have a more philosophical discussion on private or difficult to interpret information. If the profit opportunities from having private information are large, other people in the financial markets will devote the resources needed to acquire it. So if you can make like an extra return because of extra information that gives you like an advantage over the others, you are going to devote the resources needed to acquire the information. This implies that in the long run, we should expect that the degree of inefficiency in the market will be limited by the costs of obtaining the private information. So private information comes at a cost. The higher the cost, the less beneficial it is to acquire private information, and that is what is meant here. The multi-million-dollar question is, are markets efficient? Do stock prices really reflect all publicly available information in the market? Or do some traders have more information than others? Or are they just better at playing the numbers game and trade with this information to make an excessive return? Those questions can hardly be answered. Let's call them food for your thoughts on competition and efficient markets. Let's have a look at a new example number 7. Pfizer has just announced the development of a new drug for which the company is seeking approval from the Food and Drug Administration, the FDA. If approved, the future profits from the new drug will increase Pfizer's market value by 750 million euro, or 15 euro per share, given its 50 million shares outstanding. Question number 1. If the development of this drug was a surprise to investors, and if the average likelihood of FDA approval is 10%, what do you expect will happen to Pfizer's stock price when this news is announced? And question 2, what may happen to the stock price over time? Good luck. Let's have a look at the answers of example 7. Because many investors are likely to know that the chance of FDA approval is 10%, competition should lead to an immediate jump in the stock price of 1.5 euro per share. Okay? Over time, however, analysts and experts in the field are likely to do their own assessment of the probable efficiency of the drug. If they conclude that the drug looks more promising than average, they will begin to trade on their private information and buy the stock, and the price will tend to drift higher over time. If the experts conclude that the drug looks less promising than average, they will tend to sell the stock and its price will drift lower over time. Examples of possible price paths are shown in the next slide. So this graph is showing you the possible stock price path for example 7. Here we can see the stock price of Pfizer, and this is time. Okay? Current means T0, so that would be now. And we can see that the immediate jump is €1.50. Okay? So it goes from here to here, and this is exactly €1.50. If experts conclude that the drug looks more promising than average, then the price will tend to drift higher over time, which is the red line. Okay? If the experts conclude that the drug looks less promising than average, they will tend to sell the stock and its price will drift lower over time, which is the blue line. What does this all mean for investors and what are the consequences? Now, if stocks are fairly priced, then investors who buy stocks can expect to receive a future cash flow that fairly compensate them for the risk of the investment. So, in such cases, the average investor can actually invest with confidence, even though he or she is not fully informed. A good example is obviously the Pfizer case that we discussed in a previous slide. Here we saw that the investors could not be fully informed about the financial impact of the new drug because there was simply no approval yet from the FDA. But investors still decided to buy it regardless. As a result, the stock price even went up with €1.50. So this means that even though investors do not have the complete set of information available to make a thorough risk assessment, they still have enough confidence of investing money in it. And hopefully this pays off if the drug is getting more promising in the future. So from the previous slide, we understand that investors who buy these stocks because they receive a cash flow that compensates them for the risk. So that means that as a corporate manager dealing with investors in the market, you should of course avoid financial illusions and use cash flow to support your investment decisions. And we have learned from this video as well as the previous one that we have the NPV model and also the discounted cash flow model to support your investment decisions. We have come to the end of this video. My suggestion is to open the next one, which is about valuing stock using the dividend discount model. Thank you.